It seems that some of the opportunities or strategies you discuss may benefit an early career or mid-career doc rather than those of us who are late to the game. For example, the backdoor Roth IRA. It appears to benefit those who are starting out with a lower salary and a long horizon. However, it does appear to be a good strategy for a hospitalist with retirement 10 years out. Maybe meant it does not appear to be a good strategy. However, I question myself on this every time I hear people talk about it. I'm afraid I might be missing opportunities or, in fact, making other mistakes that will hurt my short timeline. In fact, I raised this on the Women's WCICon panel tonight, and several echoed my comment. In fact, one said, I'm not a second career doc, but I made financial mistakes, so I feel like I'm starting over. Whether it's due to raising kids, being a single parent, a second career, there are a lot of us who fall into this boat and are trying to catch up with everything at once, buying a house, saving for retirement, and living our lives meanwhile. If you could build a podcast around what the second career late saver should be prioritizing, many of us would greatly appreciate it. Well, this is a common sentiment. And it's amazing that I get it from people who I consider pretty young. Oftentimes docs who are in their 30s or 40s, they're quite young. I mean, there are doctors who don't come out of training until they're early or even mid 40s. And so let's be honest, a lot of people who think they're late or think they have a late start really aren't. Just because you didn't retire from medicine at 43, like the physician on fire, does not mean you are late to the game, right? You're probably still well ahead of the vast majority of not only Americans, but of your peers. Remember, the median American retires with a net worth of $250,000. That's home equity, savings, all their goods, all their assets, all their retirement, everything, $250,000. So chances are you're not really as behind the game as you think you are, but lots of people feel that way. The truth is a 35-year-old doc probably has another 50, 55 years in their life, right? That's a long time that you can benefit from a backdoor Roth IRA. But a 50-year-old doc still has 35 or 40 years, which is also a very long time. There's a lot of things that can help you in your later career to catch up. One is the fact, if you look at the vast majority of people, and I don't know whether this necessarily applies to docs, because sometimes docs are working really hard in their 30s and 40s, but in general, your highest earnings of your career are in your 50s. So when you are earning more, it's easier to save more. Plus, you oftentimes have some expenses taken care of. Maybe the kids are already into college, maybe they're through college, maybe you've already got a house. You've already got a car, whatever. You already have some things taken care of that doc coming out of residency doesn't have. So maybe, again, you're not quite as far behind as you think you are. There are also all these great catch-up contributions that allow you to use a tax-protected account where a younger doc might be forced to invest more in a taxable account, right? Your 401k or 403b, for instance, you get an extra $6,500 in 2021 that you can put in there as an employee contribution. That also increases the $58,000 limit on that account, right? If this is a solo 401k, now all of a sudden you can put $64,000 into it, or is it 64,500? Whatever it is for 2021. You can put more in there than somebody that's under 50. Same thing with your backdoor Roth IRA. Instead of putting $6,000 in there for you and your spouse, it's $7,000 each. So there's another couple $1,000s that can go into a tax-protected account. It doesn't have to be invested in a taxable account. HSAs, the catch-up age is 55. But again, for a family plan, it's another $1,000 that you can put in there each year. And these contributions, really do help you to build wealth a little bit faster. But the truth is that no doctor is ever really more than 10 years away from financial independence. Whether you're 30 and you're going to become financially independent at 40, or whether you're 50 and you're going to become financially independent at 60, or whether you're 60 and you're going to become financially independent at 70, the truth is that no doctor making any sort of a doctor income, 180, 220, $300,000, $400,000 a year. The truth is, if you will live like the average American household, which is about 60 grand a year, if you will live like they live, even if you have nothing right now, even if you have a bunch of student loans right now, within 10 years, you can reach financial independence. Yes, you're not going to be driving Teslas. No, you're not going to be, vacationing on the French Riviera, right? You're going to have the average American life as you reach there and in retirement. But the truth is, if your goal is to get to financial independence, you're never more than 10 years away. So that means even if you want a relatively robust retirement, maybe you're only 15 years away, right? And so you got to keep that in mind, that this isn't a terribly long game when you're making as much money as most doctors make. You can make it pretty quickly. You can also, if you really are in a rush and you really don't want to cut your lifestyle, you can take on more risk. Maybe you have more stocks to bonds in your portfolio than you otherwise would. Maybe you tilt to small and value stocks. Maybe you carry a little bit more debt than you otherwise would and use that to leverage your investments. Maybe you have more of a side hustle. Maybe you're doing a little bit of direct real estate investing where you can put a little bit more of your time and expertise into boosting your return. You're taking on more risk and doing more work in order to catch up. Those are all options you can do to try to catch up if you really are behind. You also get to avoid some of the early retirement issues, right? There's lots of people that worry about the age 59 and a half rule. It's not that big a deal. There's so many loopholes that you can drive a truck through them. But if you are late to the game, you don't even have to deal with that rule, right? You might be 60. Well, if you're 60, you can start taking money out of your IRAs or Roth IRAs as much as you want. No penalties whatsoever. You just have to pay any taxes that might be due on a tax-deferred withdrawal. But a lot of this comes down to comparison. You're comparing yourself to somebody who came out of residency and had already been reading The White Coat Investor for 2 years. Yeah, they hit the ground running. I encourage them to do that. We shouldn't hold that against them, right? But if you didn't find out about any of these financial principles till you were 45, of course you're going to be behind that person. But the truth is, you are not playing that person. This is not a game of you against them. It is not a game of you against the market. It is a game of you against your goals. It's a single player game. And you only win when you reach your goals. You don't win by beating somebody else or by beating the market or anything like that. So keep that in mind. I hope that's helpful. If there are a couple of blog posts on the White Coat Investor blog that might help with this, one is called Behind in the Retirement Savings Game. The other one is called I Forgot to Save for Retirement. And both of those will walk you through some of the numbers of how this works out if you're starting at 45 or 50 or 55 or 60 years old. Hope that's helpful.
My dad, your host, Dr. Dolly, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.